Hey there, this is Kritesh and welcome to TradeBrains YouTube channel. In this video, we are going to discuss how you can compare different stocks listed in Indian stock market and find out which is the best one to invest. And in order to do that, you can use our compare stock feature on our newly launched stock research and analysis portal. Just go to portal.tradebrains.in and on the top menu bar, you can find the compare stock feature. Click on the compare stock. Now this is an exclusive feature offered by TradeBrains and which is not available on any other portal yet, and it is free for everyone to use. So simply go on compare stock page and here you can write the name of different stocks that you want to compare. So let's say for the sake of simplicity we are looking into three companies in the FMCG industry. So let's say the three companies can be Hindustan Unilever, ITC and Nestle, and let's compare these three companies. So first on the stock one you can write the name of Unilever, that is. For the second company you can select ITC, and for the third company you can write Nestle India, and then click on compare stocks. So when you click on compare stock, the details about all these three companies will populate in your screen. So let's compare these three companies. So if you see Hindustan Unilever, ITC and Nestle, first you need to see the market cap of the company, that is how big the company is. The market cap of Hindustan Unilever is almost 5 lakh crore. For ITC it is almost 2.23 lakh crore and for Nestle it's 1.54 lakh crore. So easily you can see that Hindustan Unilever is the biggest company among three. However, all three of these companies are large cap companies because their market capitalization is greater than 25,000 crore. So if you compare the size, Hindustan Unilever is the biggest company among all three. The next is PE, which is price to earnings. So it basically says how much the company is valued compared to the earnings. So if the PE is 1, it means that for 1 rupees of earnings, the company is valued for 1 rupees per share. And the lower the PE ratio, it means the undervalued the company is. Now for these three companies, you can see that the Unilever has a PE of 68, ITC has 14.76 and Nestle has 78.52. So easily you can see that the highest among this is Nestle India, which is the most overvalued compared to Hindustan Unilever and ITC. Next is price to book value. This also says that how much times the company is valued compared to the book value, and as a thumb rule, lower the price to book value ratio, lower the valuation of the company, that is the company is undervalued. Again in these three companies you can see that price to book value for Hindustan Unilever is 50.39, for ITC is 3.48 and for Nestle India is 67.86. Again ITC is undervalued compared to the other two. Next let's look into the yield, that is the dividend yield of the company. This field is not much useful for those people who are not looking into dividend of the stocks or which are not interested in the dividend companies. However, it tells you how much good is the company in rewarding its shareholders as dividends, and the higher the dividend yield, the better is the shareholders to receive dividends from that company. For Hindustan Unilever, the dividend yield, that is the current yield, is 1.18%. For ITC it is 5.58% and for Nestle India it's 2.13%. And obviously ITC is giving more dividend compared to Hindustan Unilever and Nestle India. Now let's look into the profitability ratios, that is ROE and ROCE. So for both ROE and ROCE, the higher the ratio, the more profitable the company is. So ROE basically means return on equity, and it tells you how good is the company in rewarding its shareholder or how good the returns is generated compared to the equity of the company. For Hindustan Unilever, the ROE is 86.11, for ITC it's 25.66 and for Nestle it's 70.27. So obviously you can see that the ROE of these two companies, that is Hindustan Unilever and Nestle India, is way better compared to ITC, and that may be one of the reason why ITC is undervalued. As these two companies are performing well, they are a lot profitable, so they might be valued a little more compared to ITC. Now next, if you look into ROCE, ROCE is the return on capital employed, and it tells you how good is a company in rewarding its shareholders compared to the capital employed. And again, as a thumb rule, the higher the ROCE, the better the company is. So if you look into these three companies, ROE of Hindustan Unilever is the best. Next is current ratio, and current ratio is the ratio of the current assets to the current liabilities of the company. And as a thumb rule, it should be greater than 1, because a current ratio greater than 1 means that it has more current assets compared to current liabilities, and it can easily pay its obligation. So all the three companies has a current ratio greater than 1, and highest for ITC, which means that ITC can easily pay all its short terms or current liabilities, and these two companies also have current liabilities greater than 1. Next is price to sales ratio, and price to sales ratio means how much the company is valued compared to its sales. So if price to sales ratio is 1, it means that for 1 rupees of sale, it is valued rupees 1 in the market. And as a thumb rule, lower the price to sales ratio, the undervalued the company is. And here if you see in these three companies, ITC is the most undervalued in terms of price to sales ratio compared to these other two companies. And finally is the debt to equity ratio. It tells you the ratio of the debt compared to equity, and if this ratio is 0 or close to 0, this means that the company is virtually debt free. So all these three companies have very low debt to equity ratio, almost 0. It doesn't make much sense to look into this factor while comparing this three company. Now let's look into few more matrices to compare this company. First is return on equity. So here is the chart for the return on equity for the last 5 years for all the three stocks, and easily you can see that the ROE for the Hindustan Unilever is the highest, which is a very good sign. And after that comes to Nestle, whose ROE is continuously increasing. That is also a very good trend. If the ROE of a company is continuously growing for a last 5 years, this is a good sign. And finally, if you see the ROE of ITC, it is kind of stable. It is not doing good, not doing bad. It is stable for the last 5 years. If you look into debt to equity ratio, the debt to equity is almost 0 for ITC and Hindustan Unilever. It has increased somewhat for Nestle India. However, still the debt to equity ratio is less than 0.03%, which is very good. Debt to equity ratio less than 0.5 is acceptable while investing in the stocks. Next, if you look into earnings per share, it tells you how much earnings the company is making per share. So here the best trend is a rising earnings per share. So if the EPS is continuously increasing for a company, it says that the company is making more and more profit. For Hindustan Unilever and ITC, it is kind of stable. They are making stable earnings. The worst case scenario in this one can be when the earnings per share has been continuously declining. And fourth, if you look into the net profit margin, it tells you that how much profit the company is keeping compared to the revenue that it is generating. So let's say by the sales of a company is generating 100 crores, and it has expenses like paying its employee and advertisement cost, maintenance cost, other of 80 crores. So here its overall profit will be 20 crore only. That is, the profit margin will be 20 crore. So the higher the profit margin, the company is more profitable in keeping its profit. So here if you see in the case of ITC, the profit margin has been continuously increasing, which is a very good sign, which means that the company has been able to reduce its cost and make more profits by selling the same number of products. On the other hand, if you look into Hindustan Unilever, its net profit margin is kind of stable for the last 5 years, and for the Nestle India, it is also growing, which is a very good sign. So these are the 4 matrices in the terms of graphs that you can look to compare companies. Further, if you go down, you can find all the other financial ratios that you need to compare these companies, like profitability ratios, valuation ratios, debt to equity ratio, efficiency ratio, dividend yield, and few other matrices. So you can do a thorough analysis of all the companies that you want using our portal. Now if we conclude this video, in terms of profitability, Nestle India is doing very good. Its EPS is continuously increasing, its net profit margin is also increasing a lot, and in terms of valuation, ITC can be considered as undervalued. That is, it is valued less in the market compared to what it should be valued in the same industry. So that's all for this video. I hope it was useful to you, And if you want to compare any other stock, you can just go to our portal and in compare stock feature, and you can compare any other company. Keep one thing as a reminder, that always compare the companies in the same industry, that is, do apple to apple comparison. Do not compare Hindustan Unilever with HDFC Bank, as it won't make much sense. So that's all for this video. I hope it was useful to you. If you liked it, please hit the like button, and this is Kritesh signing off.